Canada just rejected 80% of Indian visa applications in 2025. And overall, the rejection rate for all international students just hit a record 62%. Now, for a country that built its housing and economic outlook around immigration and student arrivals, this is a massive shift. So let's break down what this means for the rental market, student housing, and real estate investors. The IRCC, or Immigration, Refugees, and Citizenship Canada, shows rejection rates are the highest in a decade in Canada. In 2024, Canada hosted over 1 million international students, with 39 to 41% of those students coming from India. Now that pipeline has been choked off, and we were already seeing a notable decline in organic levels of applications from a lot of these feeder countries. And because of changes at the policy level, Ottawa has doubled the financial proof requirement to $20,000, closed the student direct stream, and cut the annual cap by another 10%. So this has basically given us two really powerful factors that's massively reducing the number of non-permanent residents, especially in the student stream. And we're already seeing immense political pressure being put on the federal government to reduce the temporary foreign worker stream for non-permanent residents migration as well. Now, I've shown this chart here a couple of times. This comes from a Bank of Canada monetary policy report, which shows that strong population growth is supporting inflation and rental prices. And this was in early 2023 when they released the chart, so we were still approaching the peak. But Ben Rabidou was kind enough to update this chart, which shows the non-permanent residents beside CPI rents. And you can see that rents are coming down substantially, but the pain is going to be most visible in student housing driven cities. If the reduction comes from changes in student policy more than it's coming from changes in the temporary foreign worker program, which I am anticipating we'll see changes in the temporary foreign worker program, but it's obviously going to happen in the student stream, or already happening in the student stream first. And this is going to be especially true for those colleges that ramped up their international student enrollments massively after COVID during the non-permanent resident surge. Between 2014 and 2022, schools like Conestoga College, Loyalist, Sioux College, and St. Lawrence saw growth in international students in the hundreds to thousands of percent. These colleges are in cities like Kitchener-Waterloo, Sault Ste. Marie, Kingston, Sudbury, and Thunder Bay. And rental demand in these smaller student-focused markets was propped up almost entirely by international arrivals. And so that upward demand shock is now reversing into a downward demand shock. And this kind of brings me to my ongoing criticism of the shaky bull case for Canadian housing, which is the Canadian real estate bull case had two legs. It was population growth. So the population is going to keep growing, more people than houses. And then you've got interest rate cuts that will restore affordability or increase buying power. With the first pillar collapsing, fewer students, stricter visas, capped permits, and probably eventually, based on the political pressure I'm seeing, it seems like the Liberal Party does seem to cave pretty quickly to political pressure under Carney, probably a reversal in the temporary foreign worker program or some sort of reduction there. The demand growth is going to slow sharply. And this leaves us relying only on interest rate cuts to support prices. So cities that leaned hard on student inflows will see rising vacancy in student rentals, softer rents, which we're already seeing, and more pressure on landlords who bought at peak prices, banking on endless demand for their rentals. We're already seeing reports of higher vacancy in student-heavy markets as early as summer 2025. Even for the last school year, we were hearing about student rental landlords having a hard time renting stuff out that used to be they'd have wait lists for tenants. Now they can't find tenants. If you combine that with the high unemployment, which I recently did a video about, and I would encourage you to check that out, high unemployment for youth and newcomers and unemployment rising to 7.1%, it's a recipe for weakening rental demand, not this forever tight rental market that many expected. And that's just the demand side. I've also talked a lot about the supply side on this channel. I've done interviews with one of the foremost economists analyzing Canada's rental housing supply shock. And we're going to see more rental supply come online as well as programs like CMHC, MLI Select continue to make it economical for developers to build rental instead of condos. And you'll see more creation of rental, which will add more upward pressure to vacancy and more downward pressure to rents. And this isn't just about student visas, it's about the fragile nature of Canada's housing model. Policy is just gradually picking off all of the things that people relied on to create this bull case for Canadian real estate. For years, population growth papered over the cracks in affordability, in supply, and in productivity in Canada. And now, with stricter rules on international students and probably temporary foreign workers down the line, we're seeing what happens when that demand pillar is kicked out from under the market. So, the big question is, with population growth slowing, are rate cuts alone enough to keep Canada's housing market afloat, or are we finally staring down the risk that the bull case breaks and that there is no catalyst for recovery in Canada's real estate market, and we actually need to see this housing cycle and credit cycle come to its bottom and we rebuild it from there? I've always been of the opinion that was going to be the case, and that we would have to see, first you see your steep drop from the interest rate cycle, then you see your slow grind down from the systemic effects of unemployment rising, delinquencies rising. Not everybody's impacted, like only demand is impacted immediately by rate hikes, by your buying power gets eroded when rates go up, so your prices drop right away because buyers are the bid in the market. But then gradually the higher rate environment also impacts owners, and a lot of them are forced to sell because they can no longer afford to hold. And that's a longer, more drawn out process of clearing out all of that distressed inventory. That's what's been grinding prices down for the last couple of years. So if you want to stay ahead of these shifts in the real estate market, make sure to hit the subscribe button and feel free to join our community at Realist.ca, where we break down the numbers that investors need to see.